Audit by Nigeria's central bank last year revealed major weaknesses in the banking sector, but third-quarter results released by the banks point to further, albeit modest, recovery.
The major key thing noticed is that they seems to be having challenge growing the top lines, mainly because the market in which they play both on the treasury side and even in the interbank and even lending, I think rates crashed in that quarter.
Interest rates have been headwinds for banks in this current earnings season. So gross earnings year on year, and I think by end of the year, you hardly find banks who would report year on year growth in their gross earnings. Okay, because of interest rate movements, and also because even non-interest items have also been pretty weak this year. Second other obvious theme is we've seen some shocks in terms of asset quality, and that's largely because the Nigerian economy itself has been somewhat slow.
The usual suspects lead the way in absolute profitability for the first 9 months of 2010. First Bank was first, reporting a profit before tax of 40.7 billion naira, despite a 6 billion naira provision for bad loans. Zenith Bank follows with a profit before tax of 39.2 billion naira, while Guaranty Trust Bank was third with a profit before tax of 38.9 billion naira. Clearly, gone are the days when the growing banking sector reported strong double-digit and even triple-digit growth in profits. These days, banks struggle to grow revenues as credit growth is at best moderate.
To a large extent reduced, okay, but what I've noticed in 2010 is a few banks have rebounded. GTB topmost, secondly Stanbic IBTC. Their PBT margins have rebounded to a large extent. GTB proud to now used to do PBT margins of like 35%, and they're about 30 currently as at Q3. IBTC pretty strong as well, and they're rebounding. But the sector as a whole, margins have reduced, and I think you only start seeing that rebound over the next 1 to 2 years.
Interestingly, while official data reflects healthy GDP growth in excess of 7%, some bankers blame an economic slowdown and weak consumer demand for slow growth. Banks also struggle to keep costs down as poor infrastructure forces them to pour billions of naira into generators and buildings. On top of this, wages make up, in some cases, half of operating costs.
One thing that they can control that we still see that is very huge on the books is staff costs, and most of them are actually working towards doing that. Like just recently we found out that even EcoBank at this stage still is trying to restructure on their side. They are putting up like 400 of their staff, and we know that early 2010 and late 2009 they actually did a lot of restructuring as regards staff costs, so they are really working towards that.
Banks are also slow in moving from a model where cheap deposits are raised to fund loans to large corporates. Many of the larger banks still allocate large slices of their deposits and capital to government securities and loans to large companies. A low interest rate environment means that margins from these investments are increasingly under pressure. Indeed, it seems like banks are still looking for a safe and profitable way to boost lending to high-margin areas such as SMEs and consumers. That said, in terms of ranking, Nigeria's banking sector remains segmented, with First Bank, UBA, Zenith Bank, and Guaranty Trust Bank leading the rankings by assets. Rescued lenders such as Oceanic Bank and Intercontinental Bank have fallen off the top cadre after huge write-downs of bad debts in 2009 left them undercapitalized. Following the central bank's special audit and huge losses through bad loans, the rules of engagement appear to have changed. There now appears to be less emphasis on the battle for size and more emphasis on efficiency and profitability. In this regard, Guaranty Trust Bank appears to be leading the top 4.
For the top tier banks, a bank that continues to just stand out is Guaranty Trust Bank. Why is that? Coming off where banks got the fingers burnt in 2008 and 2009, they were part of the banks that had a solid risk management framework in place at that point to safeguard some of these avenues where banks actually lost money. So they coming up from that perspective, they are actually better off to compete in the new landscape, and that seems to be working for them.
With M&A activity looming in the horizon, analysts point to Access Bank, Nigeria's 5th largest lender as at December 2009, and Stanbic Bank, subsidiary of Africa's largest lender Standard Bank, as the most likely challengers.
Access is growing pretty well outside Nigeria, especially in terms of depth in numbers. It's only a matter of time before it translates to absolute growth at the group level. We'd also like to look at Stanbic IBTC, but it's also a longer-term play. They still have some way to go, 3-4 years, before you can even think of them making a push.
Looking ahead into the fourth quarter of this year and 2011, the activities of the newly formed Asset Management Company of Nigeria is expected to boost activity across the sector. AMCON will exchange 2.2 trillion naira in bad loans for bonds, thereby recapitalizing the 9 lenders rescued in a $4 billion bailout last year. Analysts are cautiously optimistic that this could lead to further recovery next year.
Looking at where we're coming from, loans to real sector over the past 3-4 years is really nothing much to write home about. I think going forward with tighter regulation, banks will have to restructure their loan books to ensure that they actually lend to key areas which can actually drive performance going forward. The new prudential guidelines encourages them to actually lend. These were some of the things which hindered them from lending to these particular areas in the past. And the CBN governor, having identified these particular naughty areas, has actually come up with the new prudential guidelines in terms of moderating how to provide for these loans over the next 2 to 3 years.
This remains to be seen, but at this stage, the verdict on the sector is one of moderate growth.